Michael Saylor just pulled off the biggest trade of his life, and now Wall Street wants to punish him for it. We're talking about a $54 billion score, not a million, not a billion. $54 billion in Bitcoin sitting in corporate vaults. Saylor's company MicroStrategy now controls 649,870 Bitcoin, which makes it the largest corporate holder of cryptocurrency on planet Earth. Think about that for a second. A software company that most Americans had never heard of 3 years ago now owns more Bitcoin than entire countries. But here's where this story gets absolutely wild. Saylor didn't just buy Bitcoin and hope for the best, like some tech bro gambling with venture capital money. He turned a boring enterprise software firm into what financial analysts are now calling a cheat code for the entire market. MicroStrategy became the loophole that institutional investors desperately needed. A way to own crypto exposure through the traditional stock market without actually touching cryptocurrency itself. The results? His stock has absolutely demolished the competition. While the S&P 500 churned out respectable returns, and even Nvidia had its moment in the AI spotlight, MicroStrategy's stock went parabolic. Institutional investors who couldn't or wouldn't buy Bitcoin directly could simply buy MSTR stock and ride the crypto wave with the legitimacy of a Nasdaq-listed company. Pension funds, hedge funds, and traditional money managers all piled in. Saylor had found the glitch in the financial matrix. You'd think Wall Street would celebrate this kind of innovation, right? A guy who saw the future of digital assets before anyone else, positioned his company brilliantly, and delivered massive returns for shareholders. In America, we're supposed to reward that kind of vision. That's the dream. Take a bold bet, execute flawlessly, and win big. But here's the twist that should make every American investor sit up and pay attention. The Nasdaq 100 Index Committee doesn't see Michael Saylor as a visionary. They see him as a problem. According to their rulebook, MicroStrategy has committed what they consider a cardinal sin in modern finance. By going all in on Bitcoin, holding over 50% of the company's assets in one single investment, Saylor broke their sacred diversification rules. Think about the irony here for a moment. The man makes the trade of the century, turns his shareholders into Bitcoin millionaires, and outperforms virtually every major company in America. His reward? The index committees are preparing to label his company as toxic and kick it out of the club. To them, this isn't a success story worth celebrating. It's a dangerous mono-risk violation that threatens their carefully constructed system. The punishment is coming, and it's not subtle. Financial institutions don't just politely ask you to leave when you break their rules. They delete you. And when you get deleted from a major index like the Nasdaq 100, the consequences cascade through the entire financial system in ways that most individual investors never see coming. What's about to happen to Michael Saylor isn't just about one company or one controversial bet on cryptocurrency. This is about revealing how modern markets actually work when someone wins too big, using a strategy the establishment never approved. Because when you corner the market on the future of money itself, you're not just playing against other investors anymore. You're playing against the entire traditional banking system that desperately wants to control what comes next. And they've just activated the kill switch. There's a date circled in red on every major financial institution's calendar right now, January 15th, 2026. That's when the Nasdaq 100 Rebalancing Committee meets to make their annual decisions about which companies stay in the index and which companies get the boot. For most companies, this is routine bureaucracy that happens in the background while America goes about its business. But for MicroStrategy, this isn't just another committee meeting. This is the moment when a seemingly boring rule change transforms into a potential financial catastrophe that could wipe out billions of dollars in value overnight. Here's what most individual investors don't understand about how modern markets actually operate. When a stock gets deleted from a major index, it doesn't just mean the company loses some prestigious membership status. It triggers an automatic, non-negotiable forced selling event that ripples through the entire financial system with machine-like precision. Let me explain how this mechanism actually works, because this is where the story gets truly disturbing. Trillions of dollars in passive investment funds and exchange-traded funds are hardwired to mirror the Nasdaq 100 index. The biggest one you've probably heard of is the QQQ, which manages over $200 billion in assets. These funds don't have portfolio managers making thoughtful decisions about which stocks to buy or sell based on fundamentals or future prospects. They're essentially robots programmed with one simple instruction: own exactly what the index owns, nothing more and nothing less. So, what happens the moment MicroStrategy gets officially removed from the Nasdaq 100? Every single one of these passive funds receives an automatic command to dump the stock immediately. We're not talking about a gradual strategic sell-off where smart money managers carefully time their exits to minimize losses. We're talking about institutional computers executing market sell orders without any regard for price, liquidity, or market conditions. Think about what you're doing when you place a market sell order on your brokerage app. You're essentially telling the system, sell my shares right now at whatever price someone is willing to pay. When you're selling a few hundred or even a few thousand shares, that's fine. The market absorbs it easily. But when you're talking about passive funds that collectively need to dump hundreds of millions of shares in a compressed time frame, that's when things get catastrophic. JP Morgan's analysts have been warning about exactly this scenario in their research notes to institutional clients. They're calling it a liquidity trap, and here's why that term should terrify anyone holding MicroStrategy stock or Bitcoin itself. Right now, the primary buyers of MSTR shares are these massive index funds that are required to own the stock because it's in the Nasdaq 100. But the moment deletion happens, these mandatory buyers vanish from the market instantly. Imagine you're trying to sell your house, but suddenly every single real estate investor in your city is legally required to stop buying properties. That's not a situation where you negotiate for a slightly lower price. That's a situation where you might not find a buyer at any reasonable price. The market doesn't just go down, it disappears entirely. Now, here's where Michael Saylor's empire becomes extraordinarily vulnerable. Remember, he didn't build this $54 billion Bitcoin position by just using cash sitting in the company's bank account. Saylor used one of the most aggressive financial engineering strategies in modern corporate history. He issued convertible notes, essentially loans from institutional investors who agreed to lend money in exchange for the option to convert those loans into MicroStrategy stock at predetermined prices. According to securities filings, MicroStrategy has billions of dollars in these convertible notes outstanding, with various maturity dates and conversion prices. This strategy worked brilliantly when the stock price kept climbing because the lenders were happy to either collect interest payments or convert their loans into valuable shares. But this entire structure depends on one critical assumption: that there will always be liquidity in MicroStrategy's stock. The moment that assumption breaks, everything starts to unravel. If the forced selling from index deletion causes the stock price to collapse below certain thresholds, some of these convertible note agreements have provisions that could allow lenders to demand immediate repayment. And here's the nightmare scenario that keeps financial analysts up at night. If multiple lenders simultaneously demand their money back, where exactly does MicroStrategy get the cash to pay them? The company's primary asset is Bitcoin, which is notoriously volatile and increasingly illiquid at massive transaction sizes. Saylor can't just call up Coinbase and sell $50 billion worth of Bitcoin on a Tuesday afternoon. That kind of selling pressure would crash the entire cryptocurrency market, which would make the stock price fall even further, which could trigger even more debt obligations, which would require selling even more Bitcoin. This is what financial professionals call a death spiral. Each forced action makes the situation worse, which triggers more forced actions, which accelerates the decline. And unlike a traditional bank run where regulators can step in and halt trading or provide emergency liquidity, there's no circuit breaker for this scenario. The index rules are the index rules, and the passive funds will execute their selling programs regardless of the consequences. What makes January 15th so particularly cruel is the timing. We're not talking about a decision that might happen someday if conditions deteriorate. This is a hard deadline that's racing toward us, whether Michael Saylor is ready or not. The committee will meet, they'll review MicroStrategy's asset concentration, and if the Bitcoin holdings still represent more than 50% of the company's assets, the deletion becomes automatic. Saylor knows this is coming. Every major financial institution knows this is coming, and yet There's almost nothing he can do to prevent it without abandoning the entire strategy that made him successful in the first place. He could theoretically sell some Bitcoin to reduce the concentration, but that would defeat the entire purpose of his bet and likely crash the price anyway. He could try to acquire other massive assets to diversify the balance sheet, but what company could he buy that's large enough to offset $54 billion in Bitcoin holdings? The trap has already been set. The mechanism is already in motion, and on January 15th, someone is going to pull the trigger on what could become the largest forced liquidation event in cryptocurrency history. The only question now is whether Michael Saylor has one more trick up his sleeve, or whether the system is about to make an example out of the man who dared to win too big. Now, let's talk about what happens if this death spiral actually starts spinning, because once those dominoes begin falling, the consequences don't stop at MicroStrategy's stock price, or even Michael Saylor's personal fortune. This could trigger a wealth destruction event that hits every single American who owns Bitcoin in their portfolio. Picture the sequence of events unfolding in real time. January 15th arrives, the Nasdaq committee makes their decision, and MicroStrategy gets officially deleted from the index. Within hours, the passive fund computers begin executing their programmed instructions. Hundreds of millions of MSTR shares flood the market with mechanical indifference to price. The stock that was trading at premium valuations because of its Bitcoin leverage suddenly becomes toxic inventory that institutional investors are desperate to unload. As the share price collapses, those convertible note holders start getting nervous. They're watching their investment lose value by the minute, and they start reading the fine print in their loan agreements. Some of these notes have protective covenants that kick in when the stock price falls below certain thresholds. Others have provisions that allow early redemption if the company's financial condition deteriorates. The phone calls start coming into MicroStrategy's finance department. Lenders want their money back, and they want it now. Michael Saylor finds himself facing an impossible choice. He could try to refinance the debt, but who's going to lend money to a company whose stock is in free fall and whose only major asset is a volatile cryptocurrency? He could try to raise cash by selling equity, but the forced selling has already destroyed the market for his shares. Every traditional financing option requires either willing lenders or willing equity investors, and at this moment, both have disappeared. That leaves only one option on the table, the option that Bitcoin holders around the world are praying he never has to consider. Michael Saylor would be forced to start selling the Bitcoin itself. Now, you might be thinking, so what? He sells some Bitcoin, pays off the debts, and moves on with his life. But here's where you need to understand the sheer scale of what we're talking about. MicroStrategy owns 649,870 Bitcoin. At recent prices, that's over $54 billion worth of cryptocurrency. But here's the critical thing about Bitcoin markets that most casual investors don't appreciate. Liquidity at that scale simply doesn't exist. When you or I buy or sell Bitcoin on Coinbase or any other exchange, we're dealing with amounts that the market can easily absorb. A few $1,000s, maybe a few $100,000 if you're doing well. The order book has enough buyers and sellers at various price points that our trades barely move the needle. But when you're trying to sell billions of dollars worth of Bitcoin, you're not just taking liquidity from the market, you're destroying it. Think about what happens when word starts spreading through crypto trading channels that MicroStrategy is being forced to liquidate. Every sophisticated trader on the planet immediately starts shorting Bitcoin, betting that the price is about to crash. Market makers pull their buy orders because they don't want to catch a falling knife. Retail investors who were considering buying suddenly decide to wait for lower prices. The very announcement that Saylor might need to sell creates a self-fulfilling prophecy that makes selling even more destructive. And here's the truly devastating part. Saylor doesn't need to sell all 650,000 Bitcoin to crash the market. According to cryptocurrency market analysis, dumping even. 10 or 20% of that position in a compressed time frame would overwhelm global Bitcoin liquidity. The price wouldn't just decline gradually, it would experience what traders call a flash crash, where automated selling triggers stop-loss orders, which triggers margin calls, which forces more selling, creating a cascade that can wipe out 50% of Bitcoin's value in a matter of hours. Now, multiply that impact across every American who owns cryptocurrency. Maybe you bought Bitcoin through a retirement account, hoping it would help fund your golden years. Maybe you allocated a portion of your investment portfolio to crypto because financial advisors said it was the future of digital assets. Maybe you're just a regular person who put a few $1,000s into Bitcoin because you believed in the technology and wanted to participate in what seemed like a revolutionary financial system. None of that matters when MicroStrategy starts selling. Your Bitcoin holdings get crushed right alongside institutional investors, hedge funds, and Michael Saylor himself. The crash doesn't discriminate between early adopters and recent buyers, between true believers and casual speculators. Everyone holding Bitcoin watches their portfolio value evaporate as the largest corporate holder in history dumps supply into a market that can't absorb it. But let's zoom out for a moment and ask the question that should be on every American investor's mind. How did we get to a place where one company's forced deletion from an index could potentially destroy billions of dollars in wealth across an entire asset class? This isn't normal market dynamics where buyers and sellers meet at prices that reflect supply and demand. This is a system where bureaucratic rules created by index committees can trigger automatic forced liquidations that cascade through global markets with devastating efficiency. And here's where the story takes its darkest turn. Some financial analysts are starting to whisper about something that sounds almost conspiratorial, except that the pieces fit together too perfectly to ignore. They're calling it the bank heist theory, and it goes something like this. Traditional banking institutions have been watching the cryptocurrency revolution with growing alarm for years. Bitcoin represents a fundamental threat to their control over the financial system. Central banks can't print it. Commercial banks can't lend it into existence through fractional reserve banking, and payment processors can't collect fees on every transaction. If cryptocurrency actually succeeds in becoming a mainstream store of value and medium of exchange, it undermines the entire business model that banks have used to extract wealth from the economy for centuries. But banks couldn't just ban Bitcoin or regulate it out of existence without looking like the corrupt gatekeepers that crypto enthusiasts always accuse them of being. They needed a more elegant solution, a way to seize control of the cryptocurrency market without openly attacking it. And Michael Saylor's aggressive accumulation strategy handed them the perfect opportunity. By allowing Saylor to corner the market, by letting him build an enormous concentrated position using leverage and convertible debt, the traditional financial system set up what military strategists would call a kill zone. They let him march right into the trap, accumulating more and more Bitcoin at higher and higher prices, financing it with debt structures that looked brilliant during the bull market, but become catastrophic the moment liquidity disappears. Now, with a simple rule change about index eligibility, they can trigger a forced liquidation that crashes the Bitcoin price from recent highs back down to $40,000 or $50,000. And who's going to be ready with billions of dollars in cash to buy Bitcoin at those distressed prices? The same major banks and financial institutions that have been quietly building their cryptocurrency infrastructure while publicly expressing skepticism about digital assets. Think about the wealth transfer that would represent. Saylor and early Bitcoin adopters bought in at lower prices and held through the volatility, believing they were front-running traditional finance. But if this forced liquidation scenario plays out, those same traditional financial institutions get to buy the exact same Bitcoin at massive discounts, acquiring in weeks what took Saylor years to accumulate. They don't just win, they win using Saylor's own strategy against him, taking possession of the assets he spent billions acquiring while he's forced to sell at the worst possible moment. The deletion from the Nasdaq 100 isn't a punishment for breaking diversification rules. It's the trigger mechanism for one of the largest coordinated wealth transfers in cryptocurrency history. And the brilliant part, from the traditional banking system's perspective, is that it all happens automatically. No conspiracy required, no backroom deals necessary. Just a bureaucratic committee applying their rules exactly as written, triggering market mechanisms that operate with perfect efficiency, redistributing billions of dollars in Bitcoin from crypto believers to traditional financial institutions. Michael Saylor bet everything on Bitcoin being the future of money. He staked his reputation, his company, and his shareholders' capital on the belief that decentralized digital currency would replace the corrupt legacy financial system. And now that same legacy financial system is preparing to use his own success against him, turning his greatest triumph into the mechanism of his potential downfall. The The question for every American watching this unfold is simple. Are you prepared for what happens when the largest Bitcoin holder in corporate history is forced to become the largest seller? Because ready or not, January 15th is coming. The countdown is already running. And when that deadline arrives, we're all going to find out whether Michael Saylor's Bitcoin bet was the trade of the century or the setup for the greatest market manipulation of our generation.